nothing more than an internal rate of return, or if you've been through the fixed income and you're familiar with yield to maturity, there's your money weighted rate of return. Okay, beginning with our money weighted return is also an internal rate of return, which means you can use Excel's on our functions. You'll notice later on that even of the values and an array, you can use Excel's IRR function for that. In fixed income, it is referred to as a yield to maturity. It accounts for the timing and magnitude of investment. So here's an example. You buy a share of stock for $200. A year later, it's worth $225 and it pays a $5 dividend. And you decide that, well, okay, $225, let me buy another share. So now you own two shares. You bought one at $200. Next year, you bought one at $225. A year later, they're both worth $235. So you sell them, you get $470, and you have two shares that pay a $5 dividend. You get another $10 in dividends. Well, what was your return? That becomes a curious question. Like, what do you mean? My average return? The growth rate of $1? Or the money, or the return that my money made? You're committing money at different periods of time. Look at the first period of time here. What is our holding period return for the first period of time? Well, the stock went from 200 to 225. That is PT minus P naught plus the $5. So we got 30 over 200. We made 15% in our first period. Just call that one period. What about the next period of time? Well, we have two shares that are 225 now, each are 225. We accounted for the first $25 over here, so we can't double count the 25. So they're 225. They grow to 235. We had two shares. They're up $10 a share, so we're up $20. Plus we got $10 in income over 450 because 225 times 2 is 450. We had 6.67% return in our second holding period. But notice what we did. We committed more money to at the beginning of the period that had a lower return. So the return on our money will be lower than some arithmetic return because we're committing more money at the worst returning period. If we just calculated an average return, 15 minus 6.67 divided by 2, you get 10.84. If we calculate the internal rate of return, we can use Excel's function to get that done using our calculators. Our first cash flow, CF0 is negative 200 because it's now float. CF1 is negative 220. Why? Because we bought another share for 225, but we got $5 in, so our net outflow was 220. CF2, we had inflow of 480. Forget the negative signs. We had inflow of 480 because we got 470, or they're worth 470, so we assume even if we're holding it that it is a cash inflow. 470, we got 10, 480, compute IRR, you get 9.39. 9.39, less than the arithmetic average. Why? We committed more money the investment. The time-weighted return. This is comparable across investments, and we've already seen it. It is a geometric mean return. It is the growth rate of $1 over a given time period if we're going to compare mutual fund. weighted rate of return. It is comparable across investments. So we say, well, if we committed $1 to each of these funds 4 years ago, how much would we have today? Without consideration for how we committed the money. Once we decide we want to be in investment one, we may put $1,000 in here, maybe $5,000 here, take out $2,000 there, put another $3,000 in here. Well, we're going to have a different return based on the weighting of the money that we had in. You can't use that as a comparison against other investors because, well, they might have committed money in a different way. Now, you can say, I earned this and you only earned that because I put money in at the right time. You didn't. Well, you can use it for bragging rights, but if you're looking at 4 different investments and you're determining which one you want to be in, you want to know the performance of the investment without that overlay of, well, hang on now, you got to put money in at just the right time and take money out at just the right time. No. What would $1 have grown by over 5 years? That's comparable. So how do we calculate this? We're going to break the investment period into holding periods. Thank God we already know how to calculate a holding period return, right? We break the investment period into holding periods, and each holding period will be demarcated by any significant cash inflows or outflows because we want to neutralize for those inflows or outflows. When you get to level 3 and you're going through the GIPS section, you will be required to calculate a time-weighted rate of return that accounts for cash flows that happen during the course of the period. And this is exactly how you do it. You break it into holding periods, you calculate the holding period return, calculate each one, you compound the holding period returns. Remember, we saw this on the previous one. 1 plus holding period return 1, multiplied by 1 plus holding period return 2. And let's say that that's all there was, and that was, let's say this was 9 months, and this was 15 months. Well, there's 24 months, that's 2 years. 1 over 2 will give it to you annualized. Calculate each HPR, compound the HPRs, then express it annually. So in keeping the example that we had on the previous screen, let's calculate what the time-weighted rate of return is. This is the previous example from when we calculate the money-weighted rate of return. By the way, for time-weighted rate of return, you may see it written as TWR or as TWRR. So we calculated our holding period returns. Remember, that's the first thing we do. The first period was 15%. The second period was 6.67%. Then we multiply them together. We chain multiply them together, and then we annualize it. Since it was 2 years, the example was based on 2 years, we could take the square root, the second root, or just 1 over 2, subtract out the 1. There is the geometric rate of return, which means that if we had invested $1 in that stock, by the end of the second year, we would have realized an annualized rate of 10.75%. The arithmetic return was 10.84. Remember, the geometric mean return will be less than or equal to the arithmetic mean, and as soon as there's variability in the return series, it will be less. Well, there is variability. 15%, 6.66, it should be no surprise that we get a number less than the arithmetic mean. For very large funds, they have money coming in and going out every day. So what they'll do is they'll calculate a holding period return each and every day, and then they'll simply just chain them all together. Now I put 365 in here because we have to account for the fact that, what if they have digital assets? Digital assets trade on the weekend. Bitcoin trades all weekend long, so if they have it in there, they can calculate a holding period return. Typically, if it's just restricted to publicly traded assets, this would be right around 252. The convention is to use 250 days because you can only have 250 days of returns. Subtract out the 1. This is for liquid underlyings with market prices. If you have illiquid holdings in there, you can't calculate daily returns. So let's say that you were a private equity fund holding a bunch of private companies. Well, from day to day, you don't know the change in price. You have to use a valuation model, and usually you're going to do a valuation maybe once a year or maybe quarterly. When you get to level 3 in GIPS, there are a bunch of rules about when you have to calculate your returns depending on the type of fund you are. So you stuff to look forward to. Let's make a happy person there. So this finishes that learning objective. I suggest you pause the video at this point and work through some of the examples in the reading so that you can reinforce the concepts that we just went through. Next learning objective. Let's pay attention to our keywords here. We have a calculate and an interpret. So that means if you see formulas here, you should be aware of them. Calculate and interpret annualized return measures and continuously compounded returns. Describe their appropriate uses. Continuously compounded is something you will see when we get to derivatives, specifically the options pricing model, BSM, Black-Scholes-Merton. So pay attention to it now. Okay, this is pretty straightforward here. Remember what I said earlier, all rates or all returns are quoted annually. So how do we get an annual rate from a particular period? It is just 1 plus R being the period rate, to the power of 365 over that particular period. So let's say that we had a 43-day return. How do we get an annual return? It's to the power of 365 over 43. It is whatever rate we got over that 43 days, that's our holding period return, to the power of 365 over 43. The logic here is, how many 43-day periods are there in 365? Let's say it was for 540 days, longer than a year. Well, same thing, 365 over 540, because this will be less than 1, right? So that the return will be brought down to be annualized. If it's daily, power of 365, our R is a daily return. If we had a 1-week return, it's the power of 52. If we had a monthly return, the power of 12. Quarterly return, the power of 4. So that's fairly straightforward. 7 days in a week, 365 days in a year, 52 weeks in a year, which is not entirely true, by the way. There are more than 52 weeks in a year. Most people don't seem to understand that. 7 days a week, 52 weeks a year is 364 days. A year has either 365 or 366. So this is not entirely true. If you had a weekly return, if you had a 7-day return and you calculated a weekly return, then a weekly return you calculate an annual return, it would not equal the same as if you had used 365 days, because this will only amount to 364. Just something to be aware of. Typically, now notice I've used 365. I've used 52, 12, 4. Typically there are 250. We round it out to about 250 trading days a year. You got 365. You've got 52 weekends in there, so you take out 104 days, you'll get to 261, and you've got roughly about 10 to 11 holidays. Every month has a holiday in it somewhere. So you get about 10 to 11. I think there's a couple of months with no holidays, but you get about 10 to 11 holidays in there, so usually it's 250 trading days. We think about it as 5 days in a week, 20 days in a month. Sometimes you'll see 21 days used in a month, 250 days in a year. This is becoming less and less true because of digital assets. They trade 365 days a year. Not only that, if you have a fixed income portfolio, interest accrues over the weekend. So it really comes down to convention. So just be aware that in different contexts, you might have different day count conventions. When it comes to fixed income, you'll see a lot of different day count conventions in there. The day count convention is not that important. If it was an important thing, then this would simply change to 250, and this 43 days would be 43 trading days. So if it says so many trading days, then your numerator should be the amount of available trading days. But if it just says over 43 days, well, there are 365 days in the year. The context will make it clear. Annualizing returns can be misleading because it assumes that returns can be repeated. So let's say that you buy something on Monday and it was a great week, and on Friday you sell it 5 days later and you got 8% in 1 week. Well, annualizing it to say this is my return on an annualized basis would be misleading, because the question would be, yeah, but can can you keep getting 8% every single week? Probably not. So it can be misleading, especially when you have periods with really bad performance or really good performance. Continuously compounded returns. Look what we've done here. Let's work our way backwards. Quarterly is to the power of 4. Monthlies to the power of 12. Weeklies to the power of 52. Dailies to the power of 365. Well, maybe if you go hourly and then you go by the minute, then by the second, well, it'll eventually limit out at a particular type of function. Well, what does that look like, right? That looks like Euler's constant. So we can use a continuously compounded return, which is just our ending price over our beginning price, and then we take the natural log of it. So let's say that we had an ending price of 105, a starting price of 100, take the natural log, it's 4.879%. So what is that saying? It's saying that if we invested $100 and we earned 4.897% compounded continuously, we would end with 105. So an annual rate of 5% is equivalent to a continuously compounded rate of 4.879. And we can always get to it by simply just taking whatever the interest rate is, 1 plus r. Whatever annual interest rate we have, we can take the natural log of that. We get to a continuously compounded rate. To get back to an annual rate, whatever continuously compounded rate we have, it's to the power of e. E to the power RC minus 1 will get us back to 5%. So we can see that if we put 0.04879 in our power term for Euler's constant, you get back to 5%. This right here, keep that in mind. You're going to see that later on in black. value is going to be the natural log of ST, whatever value we have, over some strike price, ST over X. Well, that is this right here. All this is giving us is a continuously compounded rate. Okay, hit the examples in the reading. We're done this learning objective. Nice and painless, right? We're done this learning objective. It's not a difficult one at all. Go through some of the examples so that you get that muscle memory, and we'll pick up with the next one when you get back. Next learning objective, another calculate and interpret for you. Calculate and interpret major return measures and describe their appropriate uses. Okay, the first type of returns here, gross and net returns, typically reported by funds. A gross return is the return that the fund earns before any deductions for management expenses, custodial fees, taxes, and so on, but after trading expenses. Basically what the fund earns. So let me see if I can give you an easy way to try to remember this. Let's say you start with $100 and at the end of the year you end with $130. Your gross return is basically 30%. It says after trading expenses. Trading expenses leave the account. But the management expense, custodial fees, taxes are paid out of the particular return. They don't leave the account until the fund manager actually pays them out. But when you trade on an exchange, you have exchange fees. They leave the account that day. So what you're left with at the end of the year is already the amount after trading expenses are done because they leave the account. Out of that $30 that you made, then you would pay your management expense, you'd pay your custodial fees, you'd pay your taxes, and so on. So the gross return is what you have, what the account ends the year with before any disbursements that didn't involve trading expenses. This is the appropriate measure for evaluating, comparing the investment skill of managers. The reason we use the gross return is, let's say that you had two returns. Another one started with 100 and ended with 125, which is 25% return. Which one did better, over 30%? But what if this one has very high fees, high management expense, high custodial fees, inefficient in the form that it generates taxes, and after you have all expenses taken out, you're left with 10%, but this one is very efficient, low fees, and you're left with 20%. This 10% and this 20 reflect the cost to the investor of choosing that particular manager, but this return represents the particular skill in that manager of earning a return. So when we're evaluating, comparing the investment skill of managers, we compare on gross returns. The net return is what the investor actually earns after all the expenses are paid. Pre-tax and after-tax nominal returns, the default is to report or state the pre-tax return, and that is very simple. If you and I were investors in a fund, the fund would not state the after-tax return because my tax rate is very different than your tax rate. And if you have 100 people in the fund, you might have 30 different tax rates going on, so that there is no one after-tax return that you can state because everybody's tax rate is different, right? Each investor's marginal tax rate may differ. Now, the components of the return may be reported so that you may then calculate what your after-tax return is. So it might say, okay, well, we had a 10% return, 2% was in dividends, 1% was in interest, and 4% was in realized capital gains. So then you can calculate what your after-tax return is based on what your tax rate is. It would be very difficult to quote an after-tax return that was appropriate for everybody, because you may have a 28% tax rate. I'm in a 50%. There is no Disney fund. The fund would not state the after-tax return because my tax rate is very different than your tax rate. And if the default is to report or state the pre-tax return, And that is very simple. If you and I were investors in a fund, the fund would not state the after-tax return because my tax rate is very different than your tax rate. And if you have 100 people in the fund, you might have 30 different tax rates going on, so that there is no one after-tax return that you can state, because everybody's tax rate is different, right? Each investor's marginal tax rate may differ. Now, the components of the return may be reported so that you may then calculate what your after-tax return is. So it might say, okay, well, we had a 10% return, 2% was in dividends, 1% was in interest, and 4% was in realized capital gains. So then you can calculate what your after-tax return is based on what your tax rate is, but it would be very difficult to quote an after-tax return that was appropriate for everybody, because you may have a 28% tax rate, I'm in a 53% tax rate bracket. So if I earn $1 of interest, I only get to keep 47 cents of it. You may have a better after-tax return on interest only because you have a lower tax rate. So you can see that it would be difficult to quote one return. Real returns. This accounts for the rate of inflation. So 1 plus the real return is 1 plus the nominal return divided by 1 plus the inflation rate. The inflation rate is typically the period over period CPI, whatever the CPI happens to be. Now when we get to controlling for inflation, it is a big discussion about, well, which inflation rate are we using? Are we using a headline CPI? Are we using a core CPI? Are we using a PCE, which is a different measure of inflation? Are we using core PCE? Are we using a trimmed CPI? There are many different measures of inflation. So if a firm or a fund is reporting a real return, the first question you should ask is, well, what version of the price index are you using? Because they may decide to use a version of the price index that is most favorable to them, that reports the highest real return. So you can make sure that that is comparable across funds. If we were all in equities, we have our nominal return for equities. We may want to know what risk premium we got for being in equities. The risk premium is the premium we get up and above what the default risk-free rate is, because we can always get that. Remember, at the very beginning, we looked at a whole bunch of risk premiums. Well, we can take 1 plus our nominal return divided by 1 plus the risk-free rate, and it'll tell us what our risk premium was. In other words, how much more in premium did we earn for taking on that particular type of risk. Okay, after-tax real returns. Again, this is not quoted for any fund because of the difference in tax rates. But what is this measuring? It is the measure of growth in purchasing power of a portfolio. So we have to part with taxes. That's not ours. So the after-tax return tells us how much our portfolio grew. Controlling for inflation tells us what our purchasing power grew by. So if our portfolio grew after tax by 3%, but inflation was 4%, we can actually buy fewer things now than we could a year ago. So we want to make sure that we're preserving the purchasing power of the assets, or even growing the purchasing power of the assets. That is a very big thing for large institutions like endowments, foundations, pension plans. When you get to level 3 and you get more into detail on these, you'll see that that is one of their big goals, is to preserve the purchasing power of their assets. Leveraged returns, because we can always borrow money to get things done. Leverage can be obtained through margin loans, through derivatives. Derivatives have what's called embedded leverage, or through collateralized loans. In fixed income, something called a repo gets you incredible amounts of leverage. So this is the general rule for when to use leverage. If the return that you can get, RP is the return on the portfolio, is greater than the cost of debt, R is your interest rate, D is debt, the interest rate on debt. If you can earn more in an investment than it would cost you to borrow the money, you should do it. Leverage enhances return. By the way, this is the very basis of something called a carry trade, where you borrow at a low rate and you invest at a high rate, and then you use leverage to lever that up. That is called a carry trade. So how do we calculate our leveraged return? It is our dollar return that we realized divided by our equity. Well, that makes a lot of sense, right? Let's say that you had a portfolio that earned $2 million and you did it on $5 million worth of equity. You have a 40% return. But what if you had $5 million worth of debt? Then your return on capital is 2 over 10, 2 million over 10 million, or 20%. But because you use leverage, you now have a leveraged return of 40%. Now this is a rather naive way to calculate it. It wouldn't just be double the amount, because there'd be some cost to debt. And here is where we calculate the cost of debt. So how do we calculate this? It is the return that we get on our portfolio. Let's say it's 8%, multiplied by the capital that we're using. There's the amount of equity and there's the amount of debt, B for borrowed money. So it's our return times how much capital we have minus how much it cost us. There's the value of our borrowed funds times the cost of debt. So this is a total return on all of our capital. This is the cost of getting the debt. The difference is the return left divided by our equity. And it simplifies to this. Some people like to know, how did you get from here to here? So I show you. All we're doing is we're going to just separate all of the terms. This is RP times VE plus VB, so it's RP times VE. separated these out. Now we're going to collect like terms where these two things cancel out, so you're left with RP. What is our common term up here? We have VB as a common term, so let's take VB out. What are we left with? RP minus RD over VE. You can see that this final term here is the same as if I had done this, right? It's the same as if I had done that. So if you wanted to know the steps on how we get here, this is how we do it. And here's Woody. This was so we must have had $3 million in borrowed funds. That would have left $7 million in equity left. Careful, don't put 3 over 10. It's VB, the value of the borrowed funds, over the value of the equity, not the value of the capital. 3 million over 7 million, there's your leverage factor. And then it is the return on the portfolio minus the cost of debt. There is the spread that we made. So it's the leverage factor times the spread we can make. And our return is 9.2857. The portfolio returned 8%. The equity returned 9.2857 because we had leverage in there. And that wraps it up. At this point, you should be, well, we've done the video. I'm not going to say pause, but do the examples in the reading. And then you have the end of chapter questions, which are a nice summation test of everything that you know from this reading. debt, you have a liquidity premium, and the longer you lend money for, you have a maturity premium. We're also going to introduce an equity premium because equity is riskier than debt. In the capital structure, debt sits above equity. What does that mean? That means that the company has to liquidate, all the debt holders get paid first, anything that's left over goes to equity. They have first priority on the assets. So because equity has to wait in line after debt, no matter how risky your debt is in the capital structure, equity will always be riskier than the riskiest debt, so there'll have to be some premium on our required return to compensate us for being in equity over debt. We should be comfortable with the notions of future value and present value. We calculate a future value, we take the current amount of money or investment we have and we compound it into the future. To arrive at a present value, if we know our future value, we discount the future back to the present. Going forward, we compound. Backwards, we discount. If you see this formulation for the negative t, it's the same as what I've shown over here. 1 over 1 plus r to the t is the same as 1 plus r to the negative t. And if we're using continuous compounding, we can calculate our future value by compounding the present value, or we can find our present value by discounting the future value. Notice the difference here. It's e to the negative present value. Calculate and interpret the present value of fixed income and equity instruments based on expected future cash flows. So we're going to look at a series of cash flows related to fixed income security and a series of cash flows in a very naive way. We're only going to look at cash flows in terms of dividends, but a series of cash flows based on equities, which are common stocks. So let's begin with 3 rules of money. You may have heard these in another context. Rule number 1, larger cash flows are worth more. I don't think I need to expand on that. Less risky cash flows are worth more. You would use a lower discount rate on those future cash flows. Good example, let's take 2 identical sets of cash flows from a bond, same coupon, same future value, except one's a corporate bond, one is a government bond. You would expect to pay more for the government bond. The cash flows are less risky. You're more certain to get them, so you would discount those future cash flows at a lower discount rate. And cash flows sooner are worth more. That is the time value of money. What complicates our assessment of what type of investment we would like is the mix between the time until we get the cash flow and the riskiness of that cash flow. So have a look at this timeline. And just by looking at it, can you tell me which one is the better one? We have an early cash flow here at time 1. Well, sooner cash flows are worth more, but it's risky. If we wait till time 2, we can take this investment. It's a nice safe one. Less risky cash flows are worth more. However, we have to wait 2 years to get our money instead of 1 year. And if we wait to year 3, we get a larger cash flow. There's our larger cash flow, but it is risky and it does take more time. Which one is the better investment to take? Well, we're going to have a different discount rate depending on how long we have to wait to get our money. The longer we have to wait, there is going to be, you'll recall from the previous reading, some maturity premium associated with it. Well, some of these cash flows are risky. Because they're risky, they will have some sort of default risk associated with them, so we'll use a higher cash flow. Whereas the safe one really just contains the 2 premiums we have here, the risk-free rate and the expected inflation rate. So we're going to have some way that we can compare all of these, and we compare them based on present value. We find a discount rate that's appropriate to each of those cash flows. We discount them. We look at the present value. Which one is the larger in terms of present value? That means it's worth the most for us today. That requires discounting at a rate that depends on the timing and the type of cash flow. And you recall from the previous reading, we introduced the components of the required return. We have our default risk-free component plus our expected inflation. If we go into corporate bonds, we have a default premium. If we are dealing with private debt, you have a liquidity premium. And the longer you lend money for, you have a maturity premium. We're also going to introduce an equity premium because equity is riskier than debt. In the capital structure, debt sits above equity. What does that mean? That means if the company has to liquidate, all the debt holders get paid first. Anything that's left over goes to equity. They have first priority on the assets. So, because equity has to wait in line after debt, no matter how risky your debt is in the capital structure, equity will always be riskier than the riskiest debt, so there'll have to be some premium on our required return to compensate us for being in equity over debt. We should be comfortable with the notions of future value and present value. To calculate a future value, we take the current amount of money or investment we have and we compound it into the future. To arrive at a present value, if we know our future value, we discount the future back to the present. Forward we compound, backwards we discount. If you have this formulation to the negative t, it's the same as what I've shown over here, p. And if we're using continuous compounding, we can calculate our future value by compounding the present value, or we can find our present value by discounting the future value. Notice the difference here. It's e to the negative rt, which is the same as 1 over e to the rt. That is for discounting a single cash flow. When we get to our fixed income securities, especially when we get to our coupon bonds, we have multiple cash flows. So I'll show you how to get that done. For discounting a single cash flow, zero coupon bonds. These are discount bonds. These are bonds sold at a discount. You pay one price and they simply mature at their face value. There is a single cash flow at maturity. This is all we need to get it done. I've got a top of the screen here. So fixed income. These are debt instruments, bonds, loans, mortgages, etc. There's a whole section on fixed income at level 1 and